How's it, guys? Welcome back to FX Rhapsody. So why do I trade price action? A lot of guys have got different ways of trading, but price action is king in trading. The more you practice trading with price action, and the more you back test it, meaning going back onto your charts to look at what price does at certain points in time, the better you will get. Your entries will be smoother, it will be better, you'll be more confident in your trading and your entries, and just adding a bit of risk to it, you will be making lots of money. So just an example of a little bit of price action trading on the USD JPY. This is now it's basically this week. What we can see is that price is making an up movement, down movement, and it's moving up again. Why does it do that? It's because it's hunting liquidity. And with that is simple little things. You have got price that turned at the top here, and you have a bottom turn over here. The top turn is where liquidity is lying. I'm breaking a line over there. And at the bottom is where more liquidity is lying. Okay, liquidity is some buy orders that's lying at the top, sell orders lying at the bottom. So basically, the guys sell the price off. They're leaving their stop orders at the top. Their risk is up there. So price is going to go and hunt that risk. Same with the bottom. Price is going to go hunt it. But how do you do your entries? Okay, what we can see is price doing a top turn, making a bottom turn. This is your big previous highs, and now you're looking closer onto the charts. This is 1 hour time frame, guys. You zoom in a little bit, and as you can see, price made a bounce off this area. It came back and did another retracement to that area, did not hit it, and now it looks like it's turning. So where does it turn? You do your relatively previous highs and lows. Okay, you look at the closest or the nearest highs and lows on your charts. So I'm just going to draw this. So for me, any area that price is breaking out of, it's hunting liquidity, because liquidity is not just on the top here. Okay, liquidity is lying everywhere where price is making a turn. Okay, liquidity is lying right there, liquidity is lying right here, and similar to this. Okay, right there, price going down, making a turn, price buying up. There is some stop orders at the bottom here, price going down, hunting that stop orders. So now it's hunting it all the time. So this is where the downwards movement comes into play, leaving its liquidity on the top there. So over here, you can see price making a turn, going up again. Now you have your previous high and price taking out that previous high, as you can see, and then making a turn back again. And with that previous high, what is created, we call it the imbalance in the market, is that fair value gap area in the market. Okay, and I've said it plenty of times, and I do it in my analysis as well. That fair value gap, you can see that big push in that candle, big bearish push. You can see price going down, okay, making its move to the downside. You can see that the candles are getting a little bit slower, it's weakening. The selling price or the sellers are weakening in the market. You get a big push to the upside by the buyers, and now price hunting that previous liquidity or the previous high, taking out that liquidity, and now creating that gap in the market, that imbalance from that candle to that candle. As you can see, there's that big gap. You highlight it across and you wait for price to come and retrace back to it. There were two retracements. The first one was this big pull down in the candle, big push down, and then the candle pulled back up again, and then you have another one forming over here. So that is where you do your entries. So your entry is right there by that area. You leave your stop loss, or your risk is basically just below that initial push on the candle where that imbalance in the market is. So you leave it just below there, and as you can see, price not tapping into that, into your risk, into your stop loss. So it just missed it, and then you can see price carrying on to the upside. And then slowly but surely, price is hunting that liquidity that it left behind, as you can see. Okay, so now it's hunting that liquidity again. So price is getting drawn to those areas in the market where liquidity is, and liquidity was left behind. These ones were taken out. Okay, all these ones were taken out by the candles going lower. It left these areas in the market, the previous highs, and now price is continuing carrying up. So where does it get drawn to? It gets drawn to the top liquidity. It pulls it up. Okay, it goes and hunts that liquidity. There's a nice little, if you missed that buy in the bottom here, you have that liquidity over here. You can see that big push in the candle over here, boof, taking that liquidity out, taking that top liquidity out, making a nice little turn back into that area of a fair value gap. Right there, there's an imbalance in the market that was left behind. Okay, in between those candles. Okay, this candle and that candle, after that initial push through that previous high that was over there, price pushing out, pushing through that liquidity, taking that out, coming back, retracing nicely into that gap. You have another area that you can buy from. A little bit of a longer risk, 18 pips, but your reward is very nice because your reward is at least, you know, to that liquidity or that previous high that was lying in the top there. So that's a 90 pip it's a 90 pip reward for a 19 pip risk. Okay, so what happens? So after price gets taken out, or the liquidity gets taken out, price returns, and now it's making its way down again. Right, so now it's left all this liquidity at the bottom here and at this area over there. Liquidity is lying there. So what you do is you do your previous low that was created right around there. Okay, so you can see price tapping into that liquidity, going up, pushing through that previous low that was created, that is intact still. It returns or retraces back. Where does it retrace back to? The little imbalance in the market that was created, that push over here, candles, okay, fair value gap in the market, price retracing back to that, and now it's making its move to the downside. And currently, if you are in a sell and you did catch this, you would have been, your risk is going to be very small. Okay, you'll have a 12 pip risk. And now where do you take your profits? You look at your previous lows and all these areas that price is hunting liquidity. Okay, these are the areas that price is going to be hunting. And as you can see, your first target would have been over here, which is already a 72 pip for a 12 pip risk, 72 pip reward, and you could have just hold it on, and right about there is 132 pips for a 12 pip reward, guys. By trading price action, practicing this, looking back on your charts to see where it does it every single time. It happens every day. It happens on different time frames, not just the hourly. You can do that all the way down to the 1 minute time frame. Guys, go practice price action. Go look at where the fair value gaps gets created. Look at where price is taking out that previous highs and previous lows in the market. And please use risk when you trade. Then you will see your profits starting to turn. Guys, that's all from my side. I hope you enjoyed this little video. If you did, don't forget to hit that like button, subscribe to my channel, hit that notification bell. It's the weekend already, so there's some nice analysis coming to you over the weekend. Guys, I hope you're staying safe. I hope you had a wonderful week, and happy trading, guys.